Bitcoin-backed loans have been the fastest-growing product in institutional crypto finance since 2023. The logic is compelling. Bitcoin holders who don't want to sell, corporations, funds, and high-net-worth investors sitting on significant unrealized gains can pledge their Bitcoin as collateral and borrow USD at interest rates far below what selling and rebuying would cost after tax. A Bitcoin holder with a $50,000 cost basis pledging Bitcoin at $100,000 to borrow $50 million avoids a $50 million capital gain while maintaining Bitcoin exposure. The 2022 crypto credit collapse wiped out the reckless first generation of crypto lenders, Celsius, Voyager, BlockFi, but it also clarified exactly which structures and counterparties are safe. Coinbase Prime, Galaxy Digital, and protocols like Aave and Compound rebuilt the market with better collateral management, real-time liquidation infrastructure, and genuine regulatory clarity. The institutional crypto credit market today is smaller, more disciplined, and more structurally sound than its 2021 predecessor. Crypto collateralized lending works through the same mechanics as securities-backed loans in traditional finance, with three key differences. First, the collateral is digital, Bitcoin or Ethereum, rather than stocks or bonds, which changes the custody architecture and liquidation mechanics. Second, loan-to-value ratios are lower, typically 40 to 60%, to account for crypto's higher volatility versus traditional securities. Third, margin calls and liquidation happen in real time. Crypto prices move continuously, and loan management systems monitor collateral value 24 hours a day. When a borrower's collateral falls to the margin call threshold, typically 60 to 70% LTV, the lender issues a margin call requiring additional collateral or partial repayment. If the threshold is breached without action, the system automatically liquidates enough collateral to restore the LTV ratio. This automated liquidation infrastructure is what failed in 2022 at Celsius and Voyager. They had insufficient liquidation infrastructure and over-collateralized loans to clients like Three Arrows Capital that couldn't be recovered. The crypto credit market has recovered substantially from its 2022 lows, but on a fundamentally different structural basis. Total institutional crypto lending volume reached approximately $35 billion in Q1 2026, still below the 2021 peak of over $60 billion but growing at 45% annually. Coinbase Prime is the largest institutional Bitcoin-backed lender in the US, with a loan book estimated at $5 to $7 billion. Galaxy Digital's lending operations generate over $200 million in annual revenue. DeFi lending protocols, Aave and Compound, collectively hold over $8 billion in total borrow volume, with WBTC representing the largest individual collateral asset. Bitcoin-backed loan interest rates average 6 to 8% for institutional borrowers with prime broker relationships and 8 to 12% for retail-adjacent customers. These rates compare favorably to traditional securities-backed lending rates when the tax efficiency of avoiding capital gains realization is factored into total cost of capital. Institutions accessing Bitcoin-backed credit have two primary pathways: centralized prime broker lending and decentralized protocol lending. Prime broker lending, through Coinbase Prime, Galaxy, or BitGo, provides customized loan terms, higher LTV ratios for established counterparties, human relationship management, and full KYC AML compliance. The trade-off is counterparty risk. The lender is a single entity, and the 2022 collapses demonstrated that even large, apparently well-capitalized crypto lenders can become insolvent quickly. DeFi lending through Aave or Compound provides fully automated, non-custodial lending where smart contracts manage collateral and liquidations without counterparty intermediary. The borrower never surrenders custody. Collateral is held in smart contracts, not by a lender. The trade-off is smart contract risk and lower LTV ratios with less flexible terms. Institutional crypto borrowers face three categories of risk that differ from traditional securities-backed lending. Liquidation cascade risk is primary. In a sharp Bitcoin drawdown, multiple borrowers simultaneously face margin calls, creating selling pressure that further depresses the collateral value. This liquidation cascade was a major factor in Bitcoin's 2022 decline. Leveraged positions being liquidated forced further price declines which triggered more liquidations. Second is custody and portability risk. If Bitcoin collateral is held by a prime broker that becomes insolvent, recovery through bankruptcy proceedings may take years. Tri-party custody arrangements with qualified independent custodians mitigate this but add complexity. Third is interest rate sensitivity. Bitcoin-backed loan rates are correlated with broader credit conditions. In a tightening environment, rates can rise significantly faster than the yield on any DeFi strategy the borrowed capital is deployed into. Galaxy Digital's institutional Bitcoin lending program provides the most instructive post-2022 case study in sustainable crypto credit infrastructure. After the 2022 collapses demonstrated the systemic risks of opaque, over-leveraged crypto lending, Galaxy rebuilt its lending book around three principles: segregated client custody with independent custodians, conservative LTV ratios of maximum 50%, and real-time automated liquidation infrastructure that activates without human intervention. By Q1 2026, Galaxy's lending book had grown to over $2 billion without a single institutional default or custody incident. The program serves corporate treasury clients who want to maintain Bitcoin exposure while accessing working capital, and crypto-native institutions that use Bitcoin-backed loans for arbitrage and market-making strategies. The infrastructure investment required, three-way custody arrangements, 24/7 liquidation monitoring, and legal documentation, is significant but has proven commercially viable at scale. Institutions establishing a Bitcoin-backed borrowing program should follow a four-step framework developed from post-2022 market infrastructure standards. Step 1 is lender due diligence. Verify the lender's custody architecture, collateral segregation policy, and automated liquidation infrastructure. Any lender that cannot demonstrate real-time liquidation capability or that commingles collateral with operating capital is disqualified. Step 2 is LTV and margin call policy establishment. Set maximum LTV at 50% or below and define internal margin call triggers that are more conservative than the lender's automatic liquidation threshold. Step 3 is custody tri-party arrangement. Establish independent third-party custody for collateral rather than allowing the lender to hold Bitcoin directly, reducing lender insolvency exposure. Step 4 is stress scenario modeling. Model the loan's performance in a 50 to 70% Bitcoin drawdown and confirm that the institution has sufficient liquidity to post additional collateral or repay principal without forced selling at distressed prices. 3 crypto credit borrowing mistakes define institutional risk management failures. First, maximizing LTV to access more borrowing without modeling liquidation scenarios. The extra leverage generates more borrowing capacity but dramatically reduces the drawdown the position can survive. Second, allowing lenders to hold Bitcoin collateral in their own omnibus wallets without tri-party custody. The 2022 collapses demonstrated that lender insolvency can trap collateral in bankruptcy proceedings. Third, borrowing for long-duration strategies with short-duration loan structures. If a Bitcoin-backed loan comes due during a bear market, the institution may be forced to sell Bitcoin at depressed prices to repay principal. The crypto credit market has rebuilt on sound structural principles after the 2022 collapse. Bitcoin-backed loans are a legitimate institutional treasury tool when executed with conservative LTV, independent custody, and stress-tested liquidity. The lessons from Celsius, Voyager, and BlockFi are specific and actionable. Apply them rigorously before committing capital to any crypto lending relationship. The crypto credit market offers institutional borrowers a tax-efficient way to access liquidity without selling Bitcoin, but only with the right structural safeguards. Subscribe to Crypto Mechanics for institutional-grade crypto analysis delivered weekly.